Good morning, ladies and gentlemen. Welcome to our today's Investor Forum. The program will start in 5 minutes. Thank you. Our distinguished NCBA customers, honorable guests, ladies and gentlemen, a very good morning. Welcome to our today's investor forum. This year themes navigating uncertain markets. My name is Dishon Muhabashi. I'm the investment advisor, NCBA Investment Bank. I'll be guiding the program. Once again, welcome. Thank you for logging in and joining this forum. We are very much excited at such a time to be with us. Thank you very much. Thank you very much. The theme of this forum is navigating uncertain markets, and it could not be more appropriate at a time when COVID-19 pandemic has really hit hard our global economy and our markets. And there's been a lot of jittery uncertainty. We know that we are slowly, recovering from the same post-COVID-19, but electioneering is already here, and people and investors are not very sure about what is going to happen next. Of course, we know during the election, foreign investors tend to take sell of position, to take their funds and invest to their own country. Of course, the US Federal Reserve has already indicated that they will raise the interest rate. Yeah, so foreign investors are 60 to 70% of our market turnover. And that will have an impact in our market in terms of prices because of course, supply in the market. Prices will a bit, nosedive. I know it is during this time people tend to take wait and see position, others tend to liquidate their investment because they are not very sure about the trajectory or market that is going to take. So to spear this conversation ahead, we have our distinguished panel of our speakers who are going to unpack and navigate around this theme. And I hope towards the end of this webinar, we are going to have a very, very helpful and insightful forum such that it's going to help you in terms of the decision that you are going to take. Because this is the question that we need to ask ourselves. What strategies are you going to take as we head towards the election? How are you going to harness the market volatility? Because we know the market is going to move up and down. Is it a time to act in fear or fear to act? What kind of sectors are you going to focus on, and what strategy? So I'm very much delighted. We have a panel of our speakers, and it's going to be very, very exciting. Welcome again. We would like to hear from you. Do post your question on our Q&A tab, and our panelists have a wealth of experience, and knowledge, and they are going to help us in further this conversation. So we have Kathure Nyambu, Managing Director, NCBA Investment Bank. We also have Alex Kiagiri, Head of Research, NCBA Investment Bank. We have Samuel Gishoi, Head of Business Development, NCBA Investment Bank. Ladies and gentlemen, it is now my great pleasure to welcome our Managing Director, Kathure Nyambu, to give her welcoming remarks. Kathure Nyambu, over to you.
Thank you, and good morning, ladies and gentlemen. It's a very warm welcome to you to another exciting session where we unpack our theme, navigating uncertain markets. Now, you will appreciate we've gone through an unprecedented global crisis on the back of the COVID-19 pandemic. And we have all lived through economic slowdown, significant economic slowdown, including shutdown of some key economies, sectors of the economy, such as hospitality, which was the hardest hit. Debt levels have gone to unprecedented levels right across the globe as our governments directed resources towards fighting the pandemic. Here in Kenya, we saw government subsidies coming through, including lowering of VAT, pay as you earn, and so on, to cushion the economy and to cushion us. unemployment levels have risen, okay? Healthcare systems have had their fair share of, challenges, some of them stretched to even breaking point. Our financial systems have been affected by non-performing loans, as people lost their jobs, companies faltered on the back of this pandemic. And on a personal level, I know some of us have lost our dear ones. And these have been economically active people, so it has cut across. However, I still see a spark of sunshine through it all, that as humanity, we have not really wasted this crisis. And so we've seen new things come through. Hybrid working has become the norm. We work from the office, we work from home, we can work from anywhere. E-commerce has flourished, okay? Many of us resorted to online shopping and so on and so forth, delivery services. We've seen alternative employment opportunities come through. I think for some of us, what we call side hustles became the main hustle, and that has shored up our economic basis. And then, interestingly, the world banded together to develop a vaccine to counter this pandemic. So the question is, have we turned the corner? Okay, we've seen vaccinations have cranked up in the recent times. I know our government is now using moral suasion to up the vaccination levels. I think they have clearly said that for us to access government facilities, you have to demonstrate that you're vaccinated, okay? Some sectors of the economy, and Dishon, my colleague, has already alluded to that, the economy is actually trending in the right direction. Some sectors are already opening up. We're happy for the hospitality to pick up. We are seeing recovery of the banking sector, which speaks to how your investments in the banking sector stocks then begins to look. So it is against this background that I'm very pleased to actually launch this webinar and to help us unpack the economy, the market that we shall be operating in, including the uncertainties that Dishon has alluded to around electioneering and so on. It's my pleasure to now invite our head of research, Alex Kiagiri, to then take us through this tapestry of the environment, of the market that we are going to find ourselves in, how we can position ourselves to leverage the opportunities that exist and go on with our wealth creation journey. So Alex, it is my pleasure to invite you to give your comments. Thank you very much.
Good morning, everyone. Thanks, Kature, for that introduction. So I'm going to give you an overview of the macro situation currently in Kenya. Granted, Kenya is not an island, so there is also some global trends that we'll discuss and have a look at. And then after that, I'll give you a view of the current stock market and our stock picks as NCBA Investment Bank in terms of what we've recommended for our clients to buy and also sell. So without further ado, I'll just talk about economic growth. So as has been mentioned, there was a definite impact of the COVID pandemic, and we saw the economy slow down. So in 2020, the GDP shrunk by 0.3%. Of course, this was due to the shutdowns and the unprecedented actions that were taken to try and stem the spread of the virus in Kenya. However, granted that our economy shrunk last year, the IMF is predicting that it will grow, and it will grow by 7.6% in 2021 and by 5.7% in 2022. So we expect the economy to grow. It's coming from a low base. Fortunately, there's been reopening of the economy. Restriction measures have been lifted, and I think with the increased vaccination rate and other containment measures, we expect that severe lockdowns won't happen, and this will give room to the economy to grow. So the lack of lockdowns will boost economic growth in our economy. So we expect that to happen against a background of global GDP growing this year. As I mentioned, a lot of countries have been affected. So the IMF estimates is that Sub-Saharan Africa will grow at around 3% from a very low base. So anyway, we expect that the sectors that will do well are the sectors that are leading the economy. So agriculture will do well, and other sectors such as drivers of GDP growth. And then once that picks up, I think you'll see more activity in the markets. In spite of the electioneering, I think the fundamentals of the market are driven by economic growth, and those fundamentals will prevail. In terms of the interest rate regime that we find ourselves in, the central bank has maintained its key policy rate at around 7%. They did this to, of course, cushion the economy, and it's definitely helped that they haven't raised rates. And I don't think this policy rate will change for the rest of the year, at least for the foreseeable future. Until we're out of the woods, we expect this rate to remain the same. And then in terms of yields, we expect this to rise consistent with the increase in the fiscal deficit and local financing by the government. Initially, the government had sought to raise 659 billion in the local markets. They've revised that to 616 billion, but it's still a big chunk of the financing of the government. So in the current fiscal year, we expect that local borrowing will bring a bit of pressure, and it will also provide liquidity. As if you've been paying attention to the government auctions, the auctions of government bonds, you'll notice that pretty much for this year, they've been oversubscribed, which is a good thing, which means that there is definitely demand for government securities, and the government is in a position where a lot of companies and corporations are hungry for its debt. So local funding should not be an issue. So the government should not have any issue. The only risk that we see in the local funding aspect is if the government borrows too much, it could crowd out the private sector. So that's something to look out for. Moving on, as I mentioned, rates have been stable, but from January to November, we've noticed a slight increase, a slight change in the yield curve. So it's bounded upwards across the 91 to 20 paper, as you see in the screen. Rates have increased across the tenors. I think this is also because of inflationary pressures and investors wanting to be compensated for inflation. As you know, government securities are very sensitive to inflation numbers, so this makes sense. And we expect that they'll probably, as we come towards the end of the year, they'll increase, though not by much, but we expect the trend to continue. Speaking of inflation, the latest inflation numbers were from October, and inflation ticked down from 6.91% in September to 6.45% in October. However, this is still within the 2.5 to 7.5 band that the central bank has mentioned that it will tolerate inflation within that band. And inflation, unfortunately, there are several risks that we have to watch out for, which will continue for the rest of the year, such as supply chain disruptions, a weakening shilling exchange rate, rising fuel and food prices, and potentially stronger demand as the economy recovers. So, speaking of these rates, not of these rates, but of these factors, if you look at supply chain disruptions, there is a lot of global supply chains that were upended by the COVID pandemic, and this could definitely have an impact on the inputs in production. So if those goods are in fewer supply, then the prices will go up. In terms of the weakening exchange rate, we are a net importer, and so the strength of the shilling is definitely a factor in driving inflation. As the shilling has been weakening this year, we expect that the cost of imported goods will go up, which will also push up inflation. And then in terms of rising food, our food basket really depends on the rains, and there's been some delay of the rains. So there's been some concern that if rains don't come in on time, the prices of food will go up. Again, this feeds directly into inflation. And fuel prices, global fuel prices have gone up. The price of oil has gone up globally, driven by a lot of economies reopening and also OPEC refusing to increase supply more than it did from last year. So we are seeing the price of oil and other related commodities go up across the board. So this will also feed into fuel prices, leading to higher inflation. In terms of the exchange rate, as I mentioned earlier, the Kenyan shilling has been sliding against the US dollar. It's currently at around 112, 113 to the US dollar. And we expect this to continue due to several factors: increased external debt servicing, fragile domestic sentiment, global safe haven flight, and balance of payment pressures. So just talking about each of those things, the government debt servicing has been up as they have issued more debt, and this is going to provide pressure. In terms of domestic sentiment, I think there's been a lot of demand for dollars and not enough supply. So that's definitely pushing it up. In terms of global safe haven flight, as was mentioned by Dishon, typically during election years, we see capital flight out of the markets and out of the country, at least until the electioning period is over. So we expect as that happens, as foreign capital leaves, then the shilling will weaken. And again, balance of payment pressures in terms of servicing ongoing debt obligations. But in terms of the foreign exchange reserves of the central bank, right now, as of October, there were 5.6 months of import cover at around 9.2 million US dollars. This meets the central bank statutory requirements to have at least 4 months of import cover. So that should at least help alleviate some of the pressures in terms of covering our import bills. And then something that's not on the slide that I should mention is October saw the highest number of remittances for the year. from Kenyans living abroad, as the markets in those Western countries, I think the largest country remittances come from is the US. As the markets there recover and the labor markets recover, we expect the conditions of the Kenyans living abroad to improve, and hence we expect to see increased remittances to Kenya. This should also help show up the shilling, because right now remittances are the largest exchange, foreign exchange earner for the country. Quickly touching on fixed income, I mentioned government has been auctioning a lot of bonds, and they have been received well. So as of October, the IFB paper, which was an infrastructure paper for 21 years, that was released by the government, has been trading the best amongst the bonds. Deals worth around 20 billion Kenyan shillings, and 838 of those deals. As demand for government securities continue to increase, and as we see significant payments in November, we think the liquidity in the market will increase. So as I mentioned earlier, we expect the yield curve to continue to steepen towards the year. This is the yield curve. As you can see, it's steepened up from January to September to end of October. So we expect that to continue to be the case. And then now to the stock market, which a lot of people will probably have a lot of questions about. I'll start with the overview of the stock market in October. So the indices barely moved. They were negative, but not by much. The NASDAQ declined by negative 0.2% month on month, and the NSE to negative 3.4%. Market capitalization, again, it decreased very slightly by negative 0.6%. Equity turnover increased, but again, it was by a small percentage, 0.42%. And as Dishon mentioned, we have 60-70% of the equity turnover in the hands of foreigners. So foreign participation increased to stand at 65% of the equity traded in the month of October. This graph just shows the chart performance for the month, for the year October last year to this year. As you can see, the market has been on an increasing trend as the economy recovers from COVID. Now on to the year-to-date performance. The NSE 20 has increased, but only by 2.06% year-to-date. This, of course, is an equal weighted index of the largest large cap counters in the market, which tells you that a lot of the action in the market has not been necessarily the large cap counters in terms of an increase. The NASDAQ All Share Index has increased by 12.17% year to date. Again, as I mentioned, this indicates that it's not just large cap counters that have been driving the returns, but small cap counters as well. So in terms of our recommendations, so we normally provide coverage for the banking sector, KenGen, and Safaricom, and we will be increasing the companies that we cover as we go into 2022. But in terms of our recommendations, as of the last stock picks, monthly stock picks. So for those of you who don't know, we normally prepare recommendations for stocks to be picked every month, and we normally share those with our clients. So as of November the 5th, when we released our last stock picks report, we have recommendations to buy, strong buy, ABSA, Corp, DTB, and Stanchart, to buy KCB and Stanbic, to hold equity, and to sell I&M. And then that's in the banking sector. In the energy and petroleum sector, we have a buy on Kengen. And right now, by the time we release the report, we hadn't included Kenya Power, but we will include it in the next stock picks report. But we do have a sell on Kenya Power. And finally, we have a sell on Safaricom as well in the last update. So that's a summary of the stock picks for the month of November. And we'll be updating this, as I mentioned, every month, and we send it out to our clients. So if you'd like to be included, please let us know. So that's an overview of the market and the macro outlook. I want to thank you for listening to me. I'll now hand it back to Dishon.
Thank you very much, Alex Kiagiri. That was very insightful. Key points to note as we go into 2022 election year, fundamental is going to prevail over sentiment, and their key sectors, which are the drivers of the economy, are going to be very resilient. Two of those sectors is agricultural sector. We also have banking sector, and this has been very evident going by the research, from our research, and also by the financials that have been released for Q3. So we really need to focus on those. Probably the banking sector will also give a very good dividend. We've seen profits have gone up by double digits. Of course, there's the issue of inflation, which is about 6%. So any return that you're looking going into 2022 has to be above 7%, so that your real rate of return, you can be able to benefit from your investment. So that's very insightful of you. We really appreciate for that. So without wasting time, we will move on to the next speaker, Mr. Samuel Gishoi. Welcome, the floor is yours.
Thank you very much, Dishon, and good morning, everyone. Thank you for joining us. We're very excited to have you, and we are really looking forward to a very productive session today. I'm going to be discussing how to harness volatility in a market which is with a lot of the uncertainty that we are facing. And one of the things that we are looking at right now, coming from the COVID-19 dip that we saw on the market, quite a bit of recovery over the last year, and of course now seeing a bit of stagnation. Then we also have ahead of us an election year. And so the expectation is that the market is going to see quite a bit of turbulence. And this turbulence is mainly driven by, of course, what investors feel about the market, the expectations of the election period, etc. So I'm going to go into a discussion on some of the tips and some of the things that you would like to be looking at as we go into this season, so that it can help you to be able to have or to structure a portfolio that is suiting to your needs. Now, a quick look at some thoughts by some of the investment gurus. I can see that one of Warren Buffett saying the rule number 1 is never lose money, but rule number 2 is never forget number 1. Well, every time I see this one, I feel like it's a genius telling me you should never fail exams, and yet I am not a genius. And so the feeling here is that, okay, I don't want to lose more money. Nobody wants to lose money, but can you actually make money consistently without losing it? Well, the answer is no. Of course, how you invest is really a function of how balanced your portfolio is and how you move it around depending on the different seasons. And so there are times when you will lose money, but the question is, what did you do about it? or what do you do about it? What sort of strategies do you put in place so that you can be able to reduce that possibility? William O'Neill then goes on to say, there are no good stocks unless they're going up in price. If they go down, you have to cut your losses fast. Letting losses run is the most serious mistake by most investors. And this sort of answers what we have seen in the last slide. It's not that you will not lose money. It is just that in a portfolio that is balanced, there are moments where you will find that either you have a stock that is losing money consistently. What objectives you had set at the onset when you were buying these stocks is very key to making a decision on when to exit, when to cut your losses, etc. So again, it is always important, and one of the things I've always mentioned in these forums is never buy something that you don't know what you're willing to sell at. Quick example, for example, when Safaricom did the IPO, of course, that was years back. I remember the price was 5 shillings. 2 days after the Safaricom came to the market, it went up to 8 shillings. That was about a 60% gain in 2 days, meaning if that had continued, of course, you would have expected exponential gain on that stock. However, somebody who had an objective of earning 30% on that stock would most probably have sold it within day 1 and day 2 and taken their profit and looked for something else. But when greed set in, you saw a lot of people holding it, and of course, we know what happened after that. There was quite a bit of a downturn on the stock. But then the other question would have come is when Safaricom went down to say 2 shillings and 50 cents, was it an idea to cut losses and sell it? Or would it have been more prudent to buy more so that you average down the price? So again, it is a strategy that you use, and it comes down to the underlying asset that you have invested in. So as we go on, let us always remember that there are times that you will cut losses. There are times that we will find that a stock or something you have invested in is going toxic. The information coming from them, their profitability, whatever product that they're trading in is probably going out of the sort of fashion or whatever we might want to call it, and you would want to cut losses and move on to something else. Now, the other thing to take into consideration, of course, is the market cycles and the volatility. And at this point in time, I think we need to just reflect back. And for those of you who have just seen what my colleague Alex, our head of research, showed us, you notice that most of the graphs he was showing, we saw quite a bit of an uptick on the market. And then towards the end of those graphs, we saw the market going down. So the question here is, at what point between discovery and deflation is our market? Now, let us remember, we are coming from a situation where, because of COVID-19, our market lost 20 to 30%, depending on which stocks you are holding. We did see over the last 1 year, in 2021, we did see the market start to recover significantly and reached a point where Safaricom touched an all-time high, KCB and Equity touched the levels of 50 shillings, 51 shillings. And so that means that they recovered significantly from where they had come from before pre-COVID. But in the last one month or 2 months, we have seen a slight decline. And my feeling is that we are somewhere between the first sentiment extreme and the bear trap. Because what happened is we saw them go to certain highs where optimism has reached a moderate extreme, and then now we saw quite a bit of profit taking, because from the bottom about a year ago to where we were at that point, we have seen quite a bit of an uptick on the market, and so that profit taking caused a dip on the market, and we have seen that correction happen. But then the question is, now we're going into an election year. What is going to happen now? Contrary to popular belief, election years in Kenya, we have seen the market go up by at least 15 to 20% over the last 3-4 election periods. And so the expectation is that in as much as history does not always repeat itself, is that in this coming election year, we may see the market again go up. The reason of this thinking is because, one, most investors during election years don't want to put money into business because the business environment becomes a little more uncertain, and so they tend to park their money in investments. And then again, the other reason, of course, is that the market is still in a recovery period, and we are reopening our economy. And we have seen, for example, in the last results announcements by the banks, that they have done very well. In fact, the increase in profitability as loans payoffs start going better. You realize that most of these companies are now in recovery mode. The economy is reopened, and so that will most probably drive an uptick on the market as we go into January, February, March results announcement period. So for me, this would then indicate that we are in a period where we should be considering, based on the fundamental value of those stocks, what we need to be buying. So as you see down there, Sir John Templeton says, bull markets are born of pessimism, grow on skepticism, and mature on optimism and die of euphoria. I think right now we are here on the skepticism and optimism bit. So I think it is a time that we should be looking at what are the best stocks going into this period. However, we need also to have an understanding of what are these external factors that would be affecting our investments. Now, a lot of the effect on a market is psychological, and it leads to doubt. And you can see, for example, a lot of talk right now is about an electioneering period, the uncertainty coming with that. So that is, of course, something that can lead you to doubt your decision making in terms of buying. Again, you can see what happened during the COVID-19 period. That is another instance. And so sometimes we need to get our head out of the market cycles that are actually happening and look more at the fundamental basis on what investments we are making. Because somebody who was holding fundamentally sound stocks pre-COVID, in as much as they dipped significantly, if they had either bought more, which means averaged down, or probably just held their position, you will note that the most fundamentally sound stocks have actually recovered significantly what had been lost. And that is why it is very important when you're making that decision not to be necessarily affected by the market cycle, but more focused also on the quality of what you're doing. So again, focus on the long-term investments and the sort of asset allocation you have. Of course, in more uncertain times, you will tend to want to be in more safer assets. For example, we have money market fund which deals more in fixed income securities, which will be a safer haven for your money when you're waiting for that time when you can now come into the more risky securities market. Of course, avoid the hard mentality. You don't just run because everyone is running. It is always good to look back and see, why did I buy something? What was the reason I bought it? Not what was the reason they bought it. A lot of the time, that person bragging about what they did and how much money they have made their decision to buy or to sell independently. So it doesn't make sense to just do it because somebody else did it. Of course, timing a market is an impossibility. It's like predicting the weather. Of course, we have a lot of scientific and research scientific basis and research to try and look at what could happen, but that does not necessarily cover what I said earlier, because psychological factors a lot of the time override some of the fundamentals. And so it is also very important to realize that if you focus on the fair value of a stock, if you focus on the fundamental, the underlying fundamental value, and even when that stock loses the value or that investment loses some value, you look back and see, why did I buy it in the first place? And if that is still true, it is a good idea to either average down on it, like by buying more rather than selling it and taking a loss. So it's always good to be patient and not erratic in making your decisions. Now, some of the reasons for short-term volatility, which have been very well covered by my colleague, Alex, some of these are really based on economic factors. For example, you can see he talked a lot about interest rates and how they will affect our economy. The perceived risk of a company, of course, based on the outlying or the externalities. For example, if you're looking at airlines during a period like COVID, of course, there's a huge risk to such companies. If you look at, say, companies that sell alcoholic beverages, with all the lockdowns and everything, they would be perceived to be risky. The expected dividends and cash flows of company are also based on the underlying economy. The supply and demand of them on the market means what is investor sentiment at that point in time in the market, and that will usually drive what is going on. So some of the things you need to look out to adopt during a very a period of uncertainty is sometimes you need to adopt a contrarian investment strategy. Contrarian means that there are times you need to decide to go against the market based on your decision-making process, which would be looking at what is this company like, what are they doing, what are the fundamentals, and a lot of that information will come from our research team. As we have said, we will usually send you our stock picks and our research notes, and that is where the basis is. And feel free to call us and discuss these things so that you understand exactly what you're buying into. Of course, sometimes you will see the herd doing, running in one direction or the other, and there are times where you can sell on bad news. I'll give you an example. Recently, because of what was happening in Ethiopia, we did see the Safaricom share dip from all-time highs of around 44, 45 down to something like where we are now trading at around 40 shillings. But if you look at Safaricom itself, the kind of company it is, the kind of profitability, they recently announced their third quarter results, the outlook, then you realize that was bad news that gave you an opportunity to buy into Safaricom. Of course, our long-term our recommendation is a sell in terms of where our research is showing us fundamentally. However, for those of you who say had bought it at 45 and it's come to 40, then that is an opportunity to also average down on your Safaricom shares so that you can position yourselves for profit in the event that it will turn up as we go into the next year. And of course, future valuations, depending on what our research team comes with, will tell us the story of Safaricom going forward. Again, look for companies that sell products that we need. Of course, we have seen some companies that we don't expect to do badly, like our power and lighting company not doing very well. However, it is usually good to have franchise products and companies that do utilities because they tend to weather storms very well. So in the time of uncertainty, look for that. Buy a business, not a stock. So never invest in a business that you don't understand. Try to understand what does the business do, what would affect the business if it was an external factor, so that you can make sound investment decisions. So again, investment is not supposed to be a stressful business. It is meant to be something you're doing for your future. So again, keep calm. It's always good to let your investments cook. Talk to our investment advisors. We are here for you. We are on call so that we can be able to do the right thing. Now, when you're choosing a good stock, there are several things that our research team will do. And so it is always good to talk to us so that we can look at the quantitative numbers. We can look at the fundamentals, what are the strengths of the underlying business and what is going on. Try and also just, look at what the industry and the growth of that product or what they're doing management, which again is a bit qualitative. And then we'll also be looking at the technical side of it, which is the fluctuations. So again, here there's a blend of research, there's a blend on human intuition, and there's also a blend of just technical knowledge and looking at what demand and supply is, especially now that we're going into day trading, which was launched officially yesterday. You're going to see that sometimes a very good technical knowledge would be analysis ability, would be very good in making decisions to enter and exit a stock. Of course, as I've always said, the biggest enemy in investment is fear and greed. Fear, particularly the fear of losing out. And this means that you don't just buy things because of price action. Price action can be very short term, and so this volatility can happen. And one of the theories I like talking about very much is the greater fool, where you see a stock going up and you quickly buy it, but tend to buy it at the top, and then it goes down slightly, you fear, and you end up repeating until, of course, you keep losing money. And we have seen a lot of investors saying, how come I keep losing money on the stock market? That is because we are allowing our emotions rather than fundamentals, rather than things that we understand, causing us to make investment decisions. So as we go forward, my call to you as our clients and as investors is that a lot of the investment decisions that we make going forward, let them be driven by a discussion with our investment advisors. Let them be driven by a knowledge of what the actual underlying stock or underlying investment we are making, what are the fundamentals, and then let us invest on a knowledgeable basis, because when things go wrong or when the turbulence happens, it will be easier to make sound decisions rather than making a rash decision based on just normal fluctuations. So again, let us go into this election year with confidence. I believe it is a time to buy. We have seen repeatedly the market go up during election years, and so towards the point of election is where then we tend to see the market again stagnate. Between now and January is a very good time to be buying, because this is holiday season. Most people will be selling to maybe finance their holidays, and during this period is very quiet, and so the chances are most stocks will be at bargain prices. Thank you very much for listening to me, and I hope that those tips will be helpful in making your investment decisions. Over to you, Dishon. And
thank you very much, Samuel. Wow, that was very, very informative. I like the way you've made the forum to be very simple, though explaining very jargon words. Three things that have stood out: contrarian investment strategy, looking for stocks that are neglected in the market, but they are of value. And this one is based on the fundamental. So that was stood out. Then there's something, you buy a business, look at the business, look at the fundamentals, avoid the hard effect. Don't buy because everyone is buying. Look, do the analysis, and this analysis should be quantitative and qualitative. The fundamentals, the business, what are the products, what is the management? So that's very key. Of course, you buy on bad news. When there's bad news, you tend to get very good stocks at a bargain price. So when everyone is buying, when the prices are high, then you're able to sell. So buying on bad news, that's a very key. Of course, something happened in Ethiopia and the Safaricom stock dropped. I think that was a very good opportunity. Anyone who bought banking stocks during the lockdown last year, I'm sure right now they are smiling all the way to the bank. So you leverage on that volatility. Fundamental is going to prevail over the sentiment. So that's very good of you, Samuel. We really thank you for that presentation. We would like to hear from you. Kindly do post your questions. I can see a couple of questions have started to come in. We want to have this forum as a discussion. And maybe I'll post this question to Samuel. Is it time to flee to safe harbors given the uncertainty in the equities during the election period? Is it time to flee to the safe harbors given the uncertainty in equities during the election period? Samuel, maybe you can handle that.
Thank you, Dishon, and thank you, David Kinyanjui, for your question. Yeah, well, as I said earlier, sometimes it's good to adopt a contrarian position in investment. It isn't wrong to be cautious, of course. Again, it's always good to be cautious during a certain period. And that is the reason why at times we look at what has happened in the past during a certain period. It doesn't necessarily inform the future, but it can inform a decision-making process. For example, I mentioned in my presentation that we have noted that over the last 4 election periods, we have seen the market actually go up. And so that means that contrary to what most investors believe, that the market goes down in election period, most people, of course, will take a wait and see stance on the market. During this period, we usually talk to investors about the stock market, and the answer will usually be, let's wait for elections first. However, but that also means that a lot of stocks going into election years will tend to be in what we call they tend to be in a discounted position, and so that means that it is a good time to buy. Buy, of course, based on fundamentals. It just doesn't mean we just buy whatever is on the market. For me, I think it is a time to actually make conscious decisions. It doesn't mean that you should be completely leveraged off you should not leverage using some fixed income part of your portfolio. So it is always good to have that part of your portfolio that is safe, which means that you look for a money market fund or a fixed income product like a bond, which will give you a consistent return. But I think this is a good time, based on my contrarian stance, to be buying because of that negative thought on the market, which means a lot of people will be looking at the market negatively, and that will give you opportunity to buy.
Thank you very much, Samuel. And thank you, David Kinyanjui, for your questions. Another question from David Kinyanjui. I think Alex Kiagiri will take this. Safaricom dipped to 36 shillings and 5 cents yesterday. Does that change your advice to sell? What are your thoughts, Alex?
Alex, you're on mute.
Sorry about that. When we looked at Safaricom and gave our view, we actually looked at 12-month outlook. So we did an update based on the Safaricom business, and we saw that the CapEx outlay would be significant going into Ethiopia. And I think our view was borne out by the fact that they didn't get the funding they were expecting from the US Development Agency, and so they had to take loans. So we still think it's a sell, and it's a sell over the next 12 months. I think until they break even, which they told us they expect to break even in 2024, and we had our projections up to 2025, we think that Safaricom will spend a lot of money in Ethiopia getting that business up and running. And it won't be until after 2025 or 2024 and they break even that the value of the Ethiopian business will start accruing to their stock. So we still maintain our sell rating.
Thank you very much, Alex. Kindly do post your questions on the Q&A tab. We'd really want to, have an engagement around this conversation. And Simon, thank you for your question. I think this one, I will give it to Samuel Gishoi. What is your view on Centum?
I think Centum has consistently been, and not really, if you look at the assets and the management and the value in the market, I think Centum is a stock that is a stock to watch, of course, depending on how their debt position will continue going forward, and of course how they, how their investments will perform. However, our research does not cover Centum per se, and so we need to look more on the fundamentals of Centum for us to be able to come out with a more, a more clear view. So Simon, I will be contacting you so that we can have a further discussion on it.
Thank you, Samuel. Another question from Simon. What informs the sell advice on KPLC with the cleanup currently? Will it be a good buy? I think, Alex, maybe you can take this.
Yes, so I think we considered the view of the cleanup happening with the IPPs and all that stuff that's been in the press. So there's been a lot of talk about renegotiating the contracts and getting the price down for the average consumer. However, when we looked at the fundamentals, it's been in a negative working capital position for years. And even though they improved performance this year, that hasn't changed. So when we look at the valuation of the company, there are still questions about whether it will be a going concern. Yes, the IPP cleanups will be good. And yes, renegotiating the contracts will be good. But however, that will not change our point of view because the financials do not support it. So we expect, or at least we hope, that the government will inject some capital to change around the financial situation. And until that happens, I think we'll continue maintaining our sell rating on KPLC.
Thank you very much, Alex. I have two questions from Haris Miruri. Haris Miruri, thank you for logging in. Samuel Gishowi, maybe you can take this up. What are your thoughts on car in general? Why should we buy Kengen?
Okay, car general is one of the smaller stocks. We haven't really done a cover over it. Most of the stocks we cover will be under what Alex has discussed. However, car general has been around for a very long time. It is not very liquid as a share in terms of the activity, in terms of buy and sell. They are in the business of selling mostly agricultural machinery and equipment, and also they've gone into the motorcycle business, which would probably bode quite well for them considering how big the motorcycle industry has become, the border industry has become in Kenya. So I think it's quite a stable, a stable company in terms of, the consistency they've had over the years. Thank you. I think the Kengen bit I would leave for Alex to handle.
Yeah, so about Kengen, we think it's a buy because of the fundamentals. So in terms of revenue diversification, unlike, first of all, in terms of profitability, and unlike Kenya Power, they've been profitable. And then there are some key drivers, which is the increase in geothermal power, which I think right now they're one of the biggest players in Africa. And they're being able to cheaply generate this power and sell it on. And then they also have some revenue diversification strategies, such as drilling. So they're drilling for geothermal plants in Ethiopia and Djibouti as well, which is bringing in revenue. And we expect as the GDP grows and as demand comes back into the market for electricity, we expect it to be the chief supplier of this demand to pretty much meet this demand. So that's why we have a buy rating on it. Again, it's a 12-month outlook. So we expect over the next 12 months, our view will bear out and Kengen will be profitable.
Thank you, Alex, for that response. There's another couple of questions coming in. Kindly, we would like to, answer your question. Do post your questions. Our panel are here. They are very experienced and have a wealth of knowledge to respond to your question. Thank you, Dennis Karaoke. I think this goes to Alex. What are the key drivers of DTB as a strong buy? That's number one. Two, what do we foresee on the impact of recent economic rebasing on the structure of economy and future fiscal policy? Samuel Gishoy, I think you can take up this. What is your take concerning housing finance? So maybe you can start with Alex.
Oh, okay. I'll start with the second question. You foresee the impact of the recent economy rebasing. So I think what happened is they had to, and this happens over in many economies and in many settings where they rebase their economic numbers. I don't think that will affect the fiscal policy. What that does is it allows a better measurement of GDP or economic activity and a better measurement of economic growth and other market statistics. So it shouldn't affect the fiscal policy. I think the fiscal policy will mostly be driven by the budgetary concerns, and right now also getting the economy to grow again after the shock of COVID. So that should be, I think for the short term, that will be what will drive the fiscal economic outlook. In terms of DTB, we did evaluation across the banks, and based on our valuation and our outlook on the results, we ranked the different banks. From a valuation perspective, I think it was one of the better buys. Better than, I think we had a strong buy on it. So it was better than the other banks in the sector based on price action. So we believe that DTB is undervalued compared to the other banks in the sector. And that's why we gave it that rating. It had stable net interest margins, which we liked. And then the non-funded income also was pretty good. So we expected that to increase. And then thirdly, we expected the cost to income ratio to improve and the asset quality to also improve. We noticed that about 48% of the total loan book comprised of government securities, which of course have lower risk and are strong assets. And we're being a bit conservative in our view based on those four things that I mentioned. But it ended up with a strong buy rating based on those drivers and strong economic fundamentals.
Thank you, Alex. Samuel, over to you. There's a question from Benedict. What is your take concerning housing finance?
I think looking at housing finance, there would be, of course, within there in the banking sector. And so we have seen most of the banking sector announcements looking very positive. So my thinking is housing finance would follow suit. Of course, the real estate sector has taken a hit, and that would probably be an underlying risk for housing finance, which has a significant stake within that area. We are, of course, yet to see what their Q3 announcement will be, and that will probably inform the direction that that the company's performance is taking, and of course that will definitely affect the way the price will move. Thank you.
Thank you, Samuel. We have questions coming in. I think this, I will give it to Samuel again. How do you individually determine stocks of value to inform investment? What opportunities exist that you can advise investors in the country during election to encourage continued local investment and discourage safe haven flight? Thank you, James, for that question. I think.
Thank you. I would avert this to Alex. He's the one that does the valuation models. So kindly, Alex, please explain a bit more on the valuation models.
Okay. So I think James is asking, if I got that right, how to how to measure value of stocks, and and the second question I think was how to discourage safe haven flight. So in terms of, I'll start with the safe haven flight one because it's shorter. So in terms of safe haven flight, I think we can't really discourage safe haven flight. As we mentioned, a lot of the action in our local stock market is driven by foreign investors, and some of those have mandates in terms of how much they can invest, where they can invest, and then they also have a right to repatriate their returns. So when they make profits, sometimes they do have to take those profits out and repatriate those profits back to their countries. So there's really no way to discourage safe haven flight. And then also in times of uncertainty, they might want to maybe park their investments or their funds in a more secure kind of instrument, so like federal bonds, federal government bonds. So they do have different mandates, different risk appetites, and right now we are an open capital economy, so we allow them to be able to repatriate their profits. So we can't discourage safe haven flight. However, we'll say, I'll reiterate what Samuel, my colleague, just mentioned, that sometimes when this happens, if a stock is of good value, you should take advantage when the market is oversold to actually buy or to average down, excuse me, on the good stocks so that you can profit when the market recovers. And then on to the first question, in terms of how we look at value of our company. So we look at several things. We look at the ability of the company to be profitable in the market. We look at its valuation relative to other companies in the same industry. And we look at its strategy, whether or not we expect the current outlook to continue for the foreseeable future. And based on those metrics, and we use different financial metrics to come up with those views, we then rate a company as a buy, a hold, or a sell, or a strong buy, if we think that its profits will be significantly higher. So we do use fundamental analysis at looking at companies, and we also do look at relative valuation. Thanks.
Thank you, Alex. For that, we have a question from Peter Mwiruri. I think this.
Sorry, Dishon, you're muted.
Sorry for that. Thank you so much, Alex. There's a question from Peter Mwiruri. I think this one Samuel Gishoi can handle it. Does the sell position for KPLC hold, even where one purchased that same stock 4 times the current price?
Thank you, Peter. Again, I'll go back to my point regarding averaging down, and of course where you bought. When we send you our recommendations, a lot of the time, of course, this is the general position of the stock, but your position as an investor is very important in whatever decision you make based on that. And as I can see here, you have already been investing in that stock at that price. And so I think for you, it would be more important to look at the reasons you bought KPLC in the first place and fundamentally why you bought it. If the recommendation is a sell and chances are that there are people or investors who will sell, it would mean that the probability would be the stock would correct. And if that does happen, then your best option in this case would be to buy more so that you average down, and then if it goes up again, you're in profit. Of course, that is also based on whether the security is toxic. I did see an earlier question regarding whether the current restructuring or recovery efforts for KPLC would be considered when giving the sell position. Of course, that is really a research function, but that means that the chances are, if this restructuring works, then chances are we could see going forward, based on what the fundamentals look like, our research team relooking at it and maybe coming up with a different opinion at that point in time. So again, this is really relative to where you are in the market at this point in time. And so I would think you would be in a good position to just hold on to it, average down every time it dips, as long as the fundamentals inform such a move. Thank you.
Thank you, Samuel. Let me take up the last question from Barbara Karaoke. Thank you, Barbara, for the question. I think Alex can take this up. Given the high yields on bond, why keep buying stocks?
Okay, so right now, so historically, stocks have typically outperformed bonds. And right now, I think because of the current situation we find ourselves in, where because of COVID, there was a lot of capital flights from the equity markets, you find that stocks dropped. But the historical relationship, we believe that the historical relationship still holds. And as has been seen over the last, I think 1 year since the lockdowns, the stock market has definitely recovered. And again, when you're looking at stocks, I'll just go back to something Bishoy said. You're looking to buy a piece of a business. So this piece of a business will generate profits, it will go out there, it will gain market share, and you'll be entitled to dividends and also to price appreciation for the stock. So I think for good companies, you definitely want to be in the stock market because the returns historically, and I don't emphasize this too much, it definitely outperforms that of the bond market in the long term. So in as much as you want to hold on to bonds in this current environment, you also want to have future price appreciation in the long term. So you definitely want to hold stocks. Something else I'd like to add though is it depends on your risk preference and what you're looking to get. So in terms of the allocation, so there's typically 60-40 allocation, 60% in stock, 40% in bonds, but that changes based on your preference and again, based on your outlook and your risk appetite. So in as much as I'm saying that you definitely want to hold stocks, again, I can't give you a specific percentage or a specific valuation of how much stocks you should hold versus bonds. So I think this is tailored based on your risk appetite and your investment horizon and factors such as that, which financial advisors can advise you as you're building out a portfolio. So you'd figure out what part of asset allocation, it's part of our asset allocation strategy, but you'd figure out what part of your assets will be allocated to bonds, what part of your assets will be allocated to equities. And if maybe you need some cash, maybe you want to have some cash investments, maybe put it in a money market fund for ease of use, things like those. So you definitely want to have exposure to it, but in terms of percentage, that's an individual decision. And please get in touch with our financial advisors and they can talk about your particular needs. and help you come up with an allocation strategy. Thanks.
Thank you, Alex. Well said, tailor-based depending on your risk profile. Allow me to take one more questions from Michael Waigwa. Thank you, Michael, for logging in and for your questions. Samuel, maybe you can assist us with this. Does brokerage facilitate purchase of stocks in US market?
Hello, thank you for that question. Currently, we only do the regional markets, and we are happy to facilitate within the Eastern, the larger East African, and the larger, larger East African region. Of course, we are working on how we can possibly, going forward, be able to avail you, this Western markets. I do believe that there is an appetite for that, and we shall address it. Thank you very much for your question.
Thank you, Samuel, for that. I think maybe this should be the very last one from Michael. Is it right time to venture into digital currency like Bitcoin as a form of investment? Samuel Gishoi, quickly.
As far as I know, Bitcoin is not a regulated currency, so we cannot comment on that because it is extremely probably speculative and out there. Thank you.
Thank you, Samuel. Ladies and gentlemen, we have come to the end of this forum. Thank you for your contribution to this call, and it has been a pleasure hosting you this morning. We do really hope that you find this forum very helpful. I will leave you with one quote from famous Warren Buffett. He said, "Be greedy when everyone is fearful, and be fearful when everyone is greedy." So even as we go into the election, you need to be greedy when everyone is fearful, so that you're able now to get prizes at a good bargain. Thank you very much for logging in and for the panel. God bless you.